affirmation of investor expectations. This is the countdown to the close. I'm Romaine Bostic alongside Alex Steele and Scarlett Fu. On the heels of a Fed meeting, we talk about a rate hiking cycle that began almost 2 years ago, a rate hiking cycle that, if you believe what Jay Powell had to say today, might officially be over.
Yeah, but for now, it's higher for longer. I wonder if he could have just wrapped up the press conference by saying, wait for Jackson Hole.
Oh, maybe. There we go. That's how you're going to lay the groundwork for September. Just to check in on the markets here, you have the S&P already grinding its way higher today, but you can really see a tick higher as the statement came out, particularly when Powell talked about September. We had a little bit of a dip, though, into the close. Also, the two-year yield, guys, that's a perfect example of what we're looking at. There you go. He says the word September, and yields go down for the day, down by about 6 basis points. I feel like this chart tells the story.
Absolutely.
It's kind of interesting, too, to see just how many times that September narrative kept coming up again and how many times he was willing to lean into it and not shy away from it. Obviously, making it clear nothing's been decided, as he always likes to say, but it sounded to me like maybe some decisions might actually be on the table.
Maximum optionality, right? That's been the mantra this whole time. Well, we know Fed Chair Jay Powell hinted that rate cuts could be on the table this fall, perhaps September, but only the data really boosts their confidence. Take a listen.
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
For some market analysis, what the impact of all this is on equities, if at all, let's welcome Stuart Kaiser. He is head of equity trading strategy over at Citi. And Stuart, I know before the FOMC decision and press conference, your take on this was that markets, at least in equities, are really much more focused on earnings. Did this idea of a rate cut in September change that idea?
I don't think it really changed our base case. This morning we were really rallying on, the Microsoft earnings from last night and some related earnings there. The FOMC, I was actually kind of surprised. I mean, the statement was a little probably more hawkish than the market might have expected, and equity futures didn't react as much, which did surprise me. I think once we got into the press conference and it became, clear that the Fed was sort of parroting what we've seen from the data, right, which is a solid labor market, easing inflation, and kind of a cut-minded FOMC, the market did respond positively to that. But, if I were to rank out the big catalyst this week, I would probably put earnings and payrolls a little bit ahead of the Fed in terms of the impact on markets. And I think that's kind of largely what you saw this afternoon in totality.
When you talk about, Stuart, the idea of what this market is pricing in with regards to rate cuts and this idea here that the Fed, at least right now, seems to be leaning into this idea that the data is pointing them in that direction, will that take precedence, whether it's at September, November, or in the December meeting?
Yeah, it really does matter, especially to the extent that they're actually cutting rates into a solid economy. And, our view coming into the year was you don't need rate cuts, but if you are getting rate cuts, it's the why that matters. And if they do 2 or 3 cuts and you're priced for about 2.5 cuts in the fourth quarter, and that happens against, let's say, payroll data that's still 150 to 200K, I think the markets will respond exceptionally positively to that. If they end up cutting, but it's in response to a weaker labor market, to me, that's a much, much different discussion. And I do think you have to worry about equity risk in that case. So, yeah, look, I do think insurance cuts in the back half or in the fourth quarter this year would be extremely positive for the markets. But, the real question is going to be, are they cutting into a strong labor market, or are they cutting because they're really worried about a deteriorating labor market in the next few months?
Yeah, which sets us up for Friday. And it was very apparent in Powell's presser that the jobs data is that critical metric for a September cut. What are the options, Mark? What's the options market in the S&P telling you for Friday now?
Yeah, I mean, you're pricing, something like a 1% move on Friday, which is a pretty large implied move ahead of a payrolls print. That said, you also get Apple and Amazon after the close on Thursday. So I think that 1 to 1.2% move has kind of been fluctuating throughout the day. I think that's capturing payrolls as well as those kind of key earnings prints. But look, our baseline view for equities this year is you run long equity risk unless and until the U.S. labor market comes under significant pressure. It does seem like the Fed is also kind of navigating in that direction, too, with kind of payrolls as the number one thing they're focused on. So it doesn't surprise me to see a lot of risk priced into payrolls because, we do see it as kind of the key risk indicator for markets. Consensus about 175K. Our U.S. economists are actually a bit below that. And I do think if you printed something sub 150K, it would definitely get the market's attention in terms of, kind of a broader slowing in U.S. labor markets.
Stuart, you say that earnings matter for the big cap tech stocks. Clearly, the jobs report matters for the equity market as well. Do earnings matter for the Russell 2000, or is it still a rotation that continues because of the macro trends?
Yeah, look, I do earnings obviously matter for small cap. It's a little tough because, only about 700 stocks in the Russell actually have positive earnings. So, like the day to day, what is EPS on the Russell probably matters a little bit less than are we continuing to get soft landing data. So I think earnings matter more for S&P and NASDAQ right now. Tick by tick, day by day, what are companies reporting? But look, the Russell is a more growth sensitive equity asset, and it's going to respond to that growth data because it is translating through to, what is the earnings profile and what is the credit risk of those small cap stocks. Honestly, one of the things we've been really focused on with investors is owning small cap, but doing it through that smaller kind of 600 to 700 stocks within the Russell 2000s that actually produce positive profitability.
Those correlations still there, Stuart? I mean, when you lay out that scenario, that sounds to me a little bit more idiosyncratic rather than something that is broadly defined.
Yeah, look, I think coming into earnings season, folks were looking at least at large cap tech earnings as a little more idiosyncratic. But the problem or the challenge is within that tech ecosystem, there's a lot of feedback, right? The CapEx that's getting spent by, let's say, a Google or a Microsoft or a Meta, that CapEx is then getting kind of consumed by NVIDIA and the semi stocks. So as much as you do have some idiosyncratic stories, you also have, I think, this very strong interlinkage amongst those large cap tech stocks, which is why the Google report last week, which kind of hinted at maybe some weaker CapEx, became so disruptive. At the Russell level, yeah, I think there's a lot more idiosyncratic risk down there, but it's just also not as well covered, right? There's not as much consensus coverage of those names. There's a little bit less focus, I think, on stock by stock or company by company. What are they doing from an earnings perspective? All
right, Stuart, got to leave it there. Stuart Kaiser, head of equity trading strategy over at Citi, on the heels of a Fed meeting where the forward guidance left unchanged. The adjectives did change, and the financial markets largely unmoved. As we push ahead now to a whole slate of earnings coming after the bell, guys, that includes Meta, Etsy, Qualcomm, Carvana, and MGM, and quite a few others.
Yep, and we got eBay as well. I think Meta is going to be quite interesting, right? It's like, as an investor on Meta, do you want to see them spend more on CapEx? Probably not. But if you're looking at growth and nice hyperscaler CapEx, you want that growth in the market, maybe you then do want them to spend.
And come on, the advertising business is doing well. They've got the Summer Olympics. They've also got the election, and the election is only heating up. So the outlook for advertising seems pretty solid.
All right, looking at the seventh consecutive Fed day now where we've seen the short end of the Treasury curve move lower and a huge rally going on in the equity space. Strongest day right now for the S&P since February. This is Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele here to help take you through the Closing Bell, a global simulcast. It starts right now with Scarlett Fu alongside us in the television studio, Carol Massar and Tim Stenovic in the radio booth, as we welcome our audiences across all of our platforms, including our partnership with YouTube. A day where we're looking at an S&P having its best day since February of this year. The NASDAQ 100, Carol, having its best day since February of last year.
I don't know about you guys, but I lost count of how many times Fed Chair Jay Powell said September, and I feel like that specificity was so important and
I know,
a key
I thought
takeaway.
At some point, like Earth, Wind, and Fire was just going to like pop out.
I love that you think that way. Cue the song. Cue the song.
Okay, though, to be fair, he did say we've made no decisions about future meetings, and it includes September. We'll be data dependent, but not data point dependent.
September.
I didn't hear September in that part.
Yeah, I'm just going to say.
Yeah, no, I mean, they're setting it. I mean, I think the question is, are they dragging their feet or are they taking baby steps? And how you kind of look at that. I saw notes from a lot of economists referring to either one of those.
Well, I mean, he needs to create room for optionality, and he certainly gets that with Jackson Hole in late August. So you wonder how much they're going to say September at Jackson Hole as well.
It'll be interesting to see whether he uses that platform. It's kind of interesting. We heard from Bill Dudley during the Fed special. He kind of talked about this idea here that if the Fed does indeed cut that first rate cut, he thinks they have to keep going. They can't do like what you're seeing over there in the ECB, as sort of do one and then wait. That if this is going to be an easing cycle, in his words, it needs to be an actual cycle.
And he said several, right? Like he said
Yes.
the word several.
Yeah.
So it just depends on what the word several actually means. Is that 7 or is that more like 3 or 4?
That next meeting, of course, September 17th, 18th. Apologies to Earth, Wind, and Fire that it did not schedule it for the 21st. We get the closing bells here in New York on this Fed day, Wednesday here, with a lot of earnings set to cross the wire. Dow Jones Industrial Average up 100 points or 0.2%. The S&P 500 up about 1.6%, while the NASDAQ Composite higher by 2.6%. And the Russell 2000 also in the green by about 0.5%. Carol.
All right, folks, let's get to Qualcomm earnings. Great read on certainly the smartphone market. So let's get to it. Let's get to the outlook. Fourth quarter revenue, $9.5 billion to $10.3 billion. So kicking it up, the estimate on the street is $9.7 billion. Fourth quarter adjusted EPS, $2.45 a share to $2.65. The estimate is $2.45. So again, upping both the top and bottom line. Go backwards. Third quarter adjusted revenue, $9.39 billion. That's a beat versus the estimate of $9.21 billion on the street. And third quarter adjusted EPS, $2.33 a share. That's 9 pennies better than what the street was expecting. And that stock you're seeing up 3% here in the aftermarket.
Yeah, certainly waiting for some commentary. The company has not updated its financial results on the website yet, so we don't have the press release. But it does see fourth quarter revenue 9.5 to 10.3 billion. Estimate was for 9.7 billion. Shares up by 5.3%.
And just quick mention here with NVIDIA's move today. It was the biggest gainer in the NASDAQ 100. On that positive note out of Morgan Stanley, it added $329 billion in value today. That is the most in market history. $329 billion.
Yeah, I was
That's
looking
something.
I was looking at the Philadelphia Semiconductor Index earlier today, and up the most going back to late 2022. Everything in there other than Skyworks and Energous were in the green, and solidly in the green, too.
Yeah, well, batch of semiconductor, right? ASML getting a boost, right? There's some exemptions maybe when it comes to some of the chip equipment makers. ADM, Advanced AMD rather, Advanced Micro Devices, right? Also their report upbeat in terms of their forecast. So there was a lot of news, I felt like, in the chip space.
Intel making some big news yesterday with layoffs. So, yeah.
And it'll be interesting, too. We get Intel reporting tomorrow, too. So maybe some of that gloom and doom or these doubts here about some of these chip companies, maybe they'll start to ratify some of those valuations. In fact, we're getting more earnings right now out of ARM Holdings, too. Of course, a big one there with that company providing guidance saying that revenue for the quarter going to come in at about $780 to $830 million. So basically a preview here of that second quarter and the revenue in the most recent quarter, the past first quarter, fiscal first quarter, a beat there as well. 939 million. Street was looking for 906.
Yeah, that's a pretty incredible number. Also, just go back to Qualcomm for a moment. They're taking a look at that fourth quarter revenue on the high end of $10.3 billion. That beats estimates. Also taking a look at the individual segments, right? You have QCT, which is basically what they make for their phone chips. That's coming in quite strong on the high end of about $8.7 billion for the fourth quarter. So these are solid numbers when it comes to guidance. Their licensing revenue also on the high end, coming at $1.55 billion on the high end for the fourth quarter.
You know, a lot of it will depend on what they say also in the conference call about their outlook for the following fiscal year, because that's when Apple's new generation of iPhones come in and the refresh cycle that's supposed to take place there. They're going to provide a really important read on demand from Apple.
Is this new phone? Is this the one that folds?
No,
this
not
is
yet.
just
AI stuff.
No.
Are you looking forward to that one?
Man.
You want the fold
You got to
thing?
wait a few years for that
I'm over
one.
folding.
Samsung does have a folding phone out.
I've heard, yeah.
Apple, not yet.
Yeah, wonderful.
If that happens.
Yeah.
If that happens.
If it happens. But it will be AI capable, right?
We're also going to
new
look
phone,
for we're going to look for some commentary out of Qualcomm in terms of China specifically, also AI. Certainly, that's an aspect for them. But this is, we've seen in terms of some of the phone market and the handset market some weakness. So we're looking, for more commentary about kind of demand later in this year and what it says about maybe the strength or the comeback, if you will. But you are seeing Qualcomm now, guys, up about 7% here in the aftermarket. This is building on a more than 20% gain here in 2024.
Yeah, they did update an investor relations website, so I am able to look through the press release. Cristiano Amon said that third quarter results reflect strong execution of our growth and diversification strategy. With QCT quarterly revenues and EBT margins at the high end of guidance, we're excited about the launch of Snapdragon Series X solutions for PCs and personalized AI experiences. It represents a significant milestone in our transformation from a communications company to a leading intelligent computing company.
I am curious to see how they articulate their longer-term future, particularly given all the reporting we've done at Bloomberg about Apple trying to basically distance itself from Qualcomm with its own chips and things. And obviously that's been pushed back, according to Mark Gurman. But at some point, this is something that Qualcomm is going to have to confront head on.
just want to hit on ARM Holdings just for a moment here. So just a reminder, their first quarter results came in about 40 cents a share. That beat their revenue, also beat their second quarter forecast. I mean, it looks pretty solid on an adjusted earnings basis. The high end just met in terms of revenue. They see on the high end of $830 million. You look at the operating expenses, though, that could be higher than estimated, coming in at $500 million versus $472.7 million. So note on that, that stock is down 5%.
Okay, we just got earnings out of Meta. So let's take a look at second quarter numbers here. Meta Platform second quarter family of apps revenue, that's the biggest part of its business, $38.7 billion, better than what analysts had expected. The platform's second quarter Reality Labs, a small part of its business, $353 million, missing the average analyst estimate of $376.9 million. As for the second quarter revenue overall, 39.07, beating the consensus estimate of 38.34, and the outlook for this quarter revenue, $38.5 billion to $41 billion. Analysts were looking for $39.16 billion, and capex for the full year, $37 billion to $40 billion. It had previously seen $35 billion to $40 billion. Analysts were looking for somewhere in the middle of the lower end of that range, $37.5 billion. So like all the other big tech companies, Carol, increasing its spending here.
Well, and this is going to be potentially worrisome, right? When they talked about it last time, we saw certainly the stock take a hit. So giving some clarification around it, but it's not like they're reining it in. The street was looking for it to maybe pull it in even more. If you look at the top end, they're saying it could go to as much as, for the fiscal year, up to $40 billion. The estimate on the street was below that by about $2.5 billion. So we're looking at Meta Platforms, though, up 8% here in the aftermarket. Also talking about fiscal year total expenses, $96 to $99 billion, a bit of a gap there. The street estimate is 97.73. So again, that can be on the higher end. But again, right now, Wall Street seems to be taking it in stride here.
I think it's notable what Mark Zuckerberg said in the press release, that he led with AI. He doesn't talk about the family of apps and the record revenue that they had there. He said we had a strong quarter. Meta AI is on track to be the most used AI assistant in the world by the end of the year. We've released the first frontier level open source AI model. We continue to see good traction with our Ray-Ban Meta AI glasses, and we're driving good growth across our apps. So he does mention the apps there, but he mentions the Ray-Bans before the apps there. I mean, that's like a tiny part of their business, but maybe that's where he sees the growth of the company.
Maybe that's where he does see the growth, and of course that feeds the conspiracy theories about those tan lines that we were talking about last week.
I knew you were going to bring that up.
Kind of interesting as well, too, when we talk about CapEx, how that CapEx spend basically staying in line with estimates for 2024, a ramp up in 2025. But I thought it was also interesting, too. I was looking at some of the ad numbers here, and ad impressions coming in, growth of about 10%, which was slightly below what the street was looking for, and a huge drop from the prior quarter a year ago, when we had about 34% growth, though. That was probably a bit of an outlier.
I just want to highlight for a second the Reality Labs thing. So Reality Labs is saying operating losses will continue for 2024. Their operating loss for the second quarter came in at $4.49 billion. So just to contrast the fact that that area of their segment, right, their virtual reality is losing billions of dollars. It will continue to lose billions of dollars this year, yet CapEx will still be on that high end of $40 billion. How do you reconcile that as a shareholder?
Is it maybe because the quarter that I just reported on, maybe because there are some beats there, and so maybe they think that they can manage the expectations? It's pretty kind of mind-blowing, because I would have anticipated that the stock would have traded lower on all of those costs. Right now, Meta is up about 5% here. You've got Qualcomm up about 4.7% in the aftermarket. ARM holding down 7%. Etsy also out, and it's gaining about 2.9% in the aftermarket. So a big drop of earnings. All right, guys, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place tomorrow.
And our coverage continues here on Bloomberg Television, keeping a closer eye on Meta. Those results just coming out, 22% revenue growth in the most recent quarter on the back of advertising, but a big focus, of course, on costs. The company basically saying that its CapEx spend in line with estimates for 2024, a bit of an increase expected for 2025. Mandeep Singh joining us right now, who covers this company for us over at Bloomberg Intelligence. Mandeep, what was the most important thing in this release to you?
Ad pricing. I mean, the fact that ad pricing grew 10%, it's a very positive sign that they are applying all those AI chips to good effect in terms of getting more money from the advertisers. And ad impressions going down actually may not be a bad thing, because prior to this quarter, they were increasing ad loads to drive up the ad impressions. Well, guess what? They don't have to show more ads, but the ads that they're showing are getting more money from the advertisers, which is why the ad pricing went up. So actually, the quality of the beat was much better than what I anticipated. And, CapEx numbers not going up is also a positive because that was a big risk.
Yeah.
How long can they keep spending, and will investors be patient here?
So it's like the ARPU goes up for the advertisements.
Exactly, yeah.
So in terms of a breakdown on that ad growth, I mean, what are you curious about in terms of the Reels business, which is kind of a clone of TikTok, versus Threads, which is a Twitter clone and right now doesn't even have advertising?
Yeah, I mean, Reels is almost 50% of their engagement right now. So look at how quickly they have transformed the entire business. I mean, Instagram, Core Blue app, all the video content has come about in the last 2-3 years. That's where they made that big push. And Reels is almost 50% of the engagement time. A lot of the ad impressions they were showing on Reels weren't monetizing that well. I think this print shows they're actually monetizing their video ads probably better than YouTube at this point, because YouTube, remember, didn't have a very good quarter. So this quarter actually kind of shows that Meta is doing better in terms of ad monetization.
So the whole Reality Labs operating loss, just kind of, we're cool with that?
Well, when you print numbers like this, I think you get a pass, because even though you are losing, that's another level they can pull. If investors were to, ask them to be more kind of efficient with their spend, guess what? They could pull that lever, but they don't have to, given operating margin expansion and the tailwind we saw with ad pricing this quarter.
Yeah, they've earned it through their ad growth. Mandeep, thank you as always. Mandeep Singh of Bloomberg Intelligence giving us the instant analysis to Meta's results. And of course, Meta share is currently gaining right now in after-hours trade. Let's bring in another voice. David Kirkpatrick is founder of Techonomy Media and, of course, the author of The Facebook Effect. David, so good to speak with you. And let me just get your thoughts first up on the CapEx, and in particular when it comes to the Reality Labs, the reality business, and how that money, that part of the business is still losing money. How much is Meta still spending on the metaverse despite it losing money versus AI? The CapEx number that gives kind of covers everything, doesn't it?
Right, but if they're losing $4 billion on Reality Labs, which I just heard somebody say, they're spending way, some 95% of that is a capital expenditure that's just not generating profits or revenue. So, they have a strange view of the future, but I do think, given their extraordinary ad growth, as Mandeep just so very eloquently laid out, and the potential they have to continue making so much money from advertising, they really can continue to invest both in AI and in their sort of whimsical metaverse experiment without really suffering very much.
Well, of course not. I mean, when you're generating $40 billion basically a quarter, which is basically the run rate now in revenue for this company on the top line, double-digit growth for a mature company, double-digit growth for a company that, 2 years ago in 2022, everyone thought the party was over. And that's when they were doing all that big spend on the metaverse, which David. Yeah. Investors pushed back on it, letting it be known to Mark Zuckerberg. They didn't like it. He folded at some point, and investors embraced it. At least for right now, investors seem comfortable with these numbers.
He didn't totally fold it either. I mean, he's still spending an awful lot of money on the metaverse, but because of the extraordinary business performance that continues, and, I think it's more controversial right now whether the AI investments will pay off, as you often discuss. This is a hugely confusing moment in the development of the technology economy. And I think every one of these companies is somewhat nervously competing with one another, attempting to outspend each other for a very uncertain long-term goal.
Well, David, that's kind of the point I wanted to make. So Google, their revenue comes in at $84 billion in the second quarter, and they get dinged. And then you have Facebook that comes in, and their revenue beats, but it comes in at $39 billion, and then they get rewarded, but they're exposed to ad sales. And ad sales is a global growth factor versus Google and data centers and cloud, which feels more like a structural shift. I just don't get it.
Well, I think majority of Google's revenue is still advertising, so I don't see it as that contradictory. I think it's weird the way that both Alphabet and Microsoft stock dropped after they beat estimates in the last few days. So, investors are strange. I don't think we can always figure out where their heads are at. But look, the fact is that Meta is an extraordinarily well-positioned, extraordinarily well-run company from a purely financial point of view. As you know, I have my serious critiques of them in other respects, but there's no question that the company is just roaring ahead with still the best targeting that any company has, with this extraordinary 4 billion user customer base we've never seen anything like this before. It's so easy to take for granted these companies, but they are moving into some areas that are world altering with very effective business models.
Yeah, a fifth straight quarter of double-digit percentage increase for quarterly revenue. One thing that people bring up a lot, David, is Llama, right? Mark Zuckerberg doesn't have to partner with an OpenAI because they've got their own large language model that they're training. It's open source right now, so my understanding is they're not collecting any licensing fee on it at the moment. You worry that this could be a source of problems for Meta down the road, maybe its ability to keep bad actors at bay. Walk us through your thinking here.
I don't think it's, from a financial point of view, I would not criticize it. In fact, I think it's generated a lot of enthusiasm in the marketplace and among developers. So open source AI has tremendous virtues from the standpoint of a business. The problem with open source AI is that people who are bad have more access to taking that code and using it in any kind of malevolent way they would choose, because they have access to the source code. That's why open source is open. And many of the other AI companies have chosen not to go that route because of their concern, in part at least, that that could be a risk. Now, it's in keeping with Zuckerberg and Meta's longstanding approach to all technologies, which is pretty much throw them out there, and if something goes wrong, figure it out later. That's just, moving fast and breaking things is still their corporate mantra, even if they prefer not to talk about it using those words.
What's sort of the next step here right now, David? Because we talk about this idea that this is still effectively an ad company, despite all the talk about the metaverse and Ray-Bans and all these other things. But clearly Zuckerberg has shown that he has ambitions to try to broaden this company out beyond that. Do you think AI, Ray-Bans, metaverse, whether this all gets folded into one in some form or another, is that going to be the future, or do you think this could be a head fake?
Oh, gee, Romaine, if I knew the answer to whether AI was going to be the answer, the successful profit-generating tool for these companies, I would be. But, nobody knows. But I think their bet is as good as anybody's. And I will say this. I am very negative on the metaverse name change, 4 billion loss, et cetera. On the other hand, if you look long-term, they might be able to find some interesting intersections between their extraordinary AI investments and Llama's success and whatever the metaverse thing turns into. So they have continued to express great confidence that we're going to be able to have sort of virtual presence look like we're actually in the same room. Who knows what AI will be able to do to improve that? So I don't bet against them from a technology development point of view.
All right, David, we appreciate it. Maybe that's what will happen when we take the close on the road. We can all be in different islands and do the close. Maybe in the metaverse. All right, David Kirkpatrick, thanks a lot, founder of Techonomy Media. All right, we got a lot of earnings for you that are continuing to come out. I'm taking a look at MGM. Overall net revenue coming in stronger than estimated at $4.33 billion. You had adjusted earnings also coming in at 86 cents a share. And I do have to say, their MGM China net revenue was up 37% year on year. And that was also a beat. So was the Las Vegas Strip resorts, coming in about $2.21 billion, despite the fact the stock is down by about 3%.
All right, let's take a look at Carvana. Those shares had been oscillating between gains and losses, now up about 9% here in after hours trading. Revenue coming in as a beat in the most recent quarter, $3.4 billion. Street was looking for $3.2. EBITDA, as well as EBITDA margin, also a beat here in the most recent quarter, and the company providing guidance for the full 2024 year, adjusted EBITDA of $1 billion to $1.2 billion. Even the lower end of that range is more than $100 million above the average of Street estimates. A big part of the reason why you're seeing the shares higher. We should also point out that unit sales of vehicles in the most recent quarter also coming in well above estimates.
All right, let's take a look at eBay. It is moving up in the after hours trading. In terms of second quarter numbers, it was a beat on the revenue line, $1.39 on adjusted EPS. Active buyers unchanged from the same time a year ago, but slightly higher than what analysts were looking for. The third quarter revenue outlook of $2.5 to $2.56 billion. It's a range, and the midpoint is just a hair below the consensus estimate of $2.54 billion. Nonetheless, you see that the stock is maintaining its gain in after-hours trading. And by the way, eBay maintains its quarterly dividend at 27 cents a share.
All right, taking a look at Etsy here. On revenue, Etsy actually beat estimates. It was up by 3% year on year at $647.8 million. Its marketplace revenue was also at about over $470 million. That was also a beat. Earnings coming in a little lighter, though. Gross merchandise sales, that's the one to look at. That's down by about 2% at $2.95 billion. It was down 2% on a year-on-year basis. I should point out also the CFO, Rachel Glazer, has announced her retirement. She will remain in her role until its successor is appointed. This according to the company release. All right, we're going to stick with earnings for you. We're going to break down all of them. We got Qualcomm, eBay, Carvana. We'll delve deeper next. This is The Close on Bloomberg.
It's Jobs Day, and Bloomberg has the report under surveillance.
Do you think the jury's still out on the strength of the labor market?
Well, part of the problem is that July is usually a very bad month for jobless claims accuracy.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
We see the jobless numbers climb just bit by bit by bit. Is this a welcome cooling or an unwelcome deterioration?
The July Jobs Report, Friday on Bloomberg.
A wave of earnings coming out after the closing bell. Let's get you a roundup of some of those notable movers. Want to bring in Bloomberg's Bailey Lipschultz, Isabelle Lee, and Alexandra Semenova. Bailey, let's start with you on Qualcomm.
Yeah, Alex, who says you have to be focused on AI to have fun in the chip space? Qualcomm up more than 6% post-market, beating expectations, driven by a lot of demand for smartphones. Stock was up more than 8% on the day, given that kind of rush back into semiconductors names. Want to call out their strong third quarter revenue guidance, expecting between $9.5 and $10.3 billion above the midpoint what Wall Street was looking for at $9.7 billion. Also saying profit will be between $2.45 and $2.65 a share. Street had been penciling in $2.45, so well above what Wall Street was looking for. Another big print, though, from the semiconductor space in the wake of AMD. Going to be interesting to see if this follows through tomorrow. Isabelle, what's going on with retail?
I'm looking at eBay. We have the company reporting adjusted EPS from continuing operations that beat estimate. You see the stock higher by around 1.7%. The number came in at $1.18, so that's higher year over year and higher than the $1.13 estimates. It's also a beat across the board. Net revenue came in higher, as did active buyers. We also have gross merchandise volume coming in higher than expected. So the reason why I think we're not seeing a bigger pop is really the third quarter revenue estimate. So the company reported a $2.5 billion to $2.56 billion, so that's a range. And the estimate is right smack in between, around $2 billion. 2.54 billion. All the numbers are confusing me, but it's just within the range. As for quarterly dividends, eBay maintained that its regularly quarterly cash dividend is at 27 cents per share, and the dividend declaration date is July 31. Stock is still up at around 1.6%, but year to date, it's up 26%. What do you got, Alex?
Hey, Isabella, I'm looking at used car retailer Carvana. Yes, that is the maker of those massive car vending machines. The stock is up about 11% here. That is after the company reported revenue and vehicle sales that beat Wall Street estimates, also reporting a surprise profit. Net income in the period was $48 million. That handily topped analyst estimates for a loss of $16 million. Carvana, of course, has been on a tear since late last year after a turnaround in its business where it cut costs and reduced some of its debt. It was battered back in 2022 during the post-COVID rout as higher interest rates shunned some buyers out of the used car market. But since then, it has returned to being a profitable leader in the industry. In fact, analysts at BTIG called Carvana's margins industry leading. It has reported gains after 6 of its last 8 earnings reports, including the last 2 where it rose more than 30% each time. The stock was up about 152% this year going into this report. Still, though, not a lot of love for from Wall Street. The stock has 6 buy ratings, 14 holds, and 3 sells. It's going to be interesting to see how this move holds up tomorrow. Guys?
Yeah. Well, who needs a buy rating when you got a 150% rally in 6 months? Our thanks there to Alexandra Semenova, Isabelle Lee, as well as Bailey Lipschultz. A nice roundup of some of the earnings here in after hours trading. We should point out Carvana, at least among the mid to large caps, the biggest mover in after hours trading, up 10%. And I'm still astonished at just how much this stock has rebounded. I know it's nowhere near its old highs, but when you consider it dropped 99% and the fact that it's rallied, almost 200%
it's a
off
massive
those lows.
roller coaster ride. I know that you were recently in the market for a car. Did you go to a vending machine to get a car?
Yeah, I was a little disappointed. There was no vending machine. I bought a new car, so I don't know. Maybe they don't do that with a new car. A new car, they just jack you for as much money as they can and then push you out the door.
True.
But I have to say, it was kind of interesting to see too the lack of inventory on the lot, and I don't know if this is just indicative of that particular dealership, but it was still pretty sparse. Not quite as bad as what you saw if you went to a dealership in 2021 or 2020, but it was certainly still sparse.
You know where you could probably get a car? Tesla. You could probably get a Tesla. They're not going to have any inventory issues on that one. I mean, you can make an argument that it's the EVs that are plethora at the dealers. If you
that was the other thing, too. You didn't see a whole lot of EV or even hybrids, other things.
Yeah, definitely
a lot
hybrids.
of ICE vehicles were available if you want them.
No, the hybrids are hard to find, but you can also go to like Hertz or Avis selling off their used EVs as well.
But they're still like almost 30 grand.
I know.
I mean, at best, you get like maybe 19
for used
21 for used Tesla. Yeah.
But that's actually enticing some people. I mean, considering some of those were like 50, 60 grand brand new.
I suppose, yeah.
All right, coming up, we're going to dive a little bit deeper into those earnings out of Meta. Stick with us. This is Bloomberg. Results coming out of Meta Platforms here. Better than expected sales in the most recent quarter. That ad business still the juggernaut that it's always been. Some concerns, though, about CapEx spending. CapEx spending that's going to hold, at least in 2024, at current levels. 2025, though, the company's saying it will continue to go up as it pushes deeper into the AI space. Kurt Wagner joining us right now, who follows this company for us here at Bloomberg News. And Kurt, let's start off first with the CapEx side of this, because I think a lot of people were wringing their hands coming into this report. I think they got some good news that the spend, at least for right now, isn't going any higher than where it's been, though they did kind of intimate here that 2025, it will go up.
Yeah, I think the story with Meta right now is just simply the balance between investing in this long-term AI stuff, both with LLMs and other, chatbots, things like that, and also the metaverse, and staying focused on, the core money-making business, right, which is the advertising business for Facebook and Instagram. And so I think that is the tension, as you point out. They've said, hey, in 2025, we are going to increase that spend. It shouldn't really be a surprise to people. Mark Zuckerberg has been saying this publicly pretty much every time he goes out and speaks these days. But I think, getting that confirmation from the company, knowing that they are going to continue to invest billions of dollars in this space is giving some people some pause.
But, they narrowed the range that they're going to spend on CapEx for 2024 to $37 billion to $40 billion. Were you surprised that it wasn't more? Like, was there a whisper number out there? Because it does seem like there's a relief that we didn't go over that $40 billion.
I wasn't surprised only because they had just raised the top half of that range to $40 billion at the end of the last quarter, and they did get a lot of pushback from that. If you recall, the stock had a really tough day. And so I think, they probably got some idea that, hey, that's the top of the range that the street's going to be happy with. Now, the fact that they've said, again, 2025 is going to be much bigger, they haven't given a range yet for that. That will be interesting when they do, because, again, I think there's a little bit of concern that Mark Zuckerberg, especially with the metaverse, is just really spending some people think a little too aggressively in that direction. So once we get the range for 2025, I think that's when you're going to see some more movement there.
What does Meta have to show for the metaverse right now? Does it do anything? Is there anything happening on the metaverse?
The metaverse is not really giving them much except for stuff to talk about, right? A hope for the future or a goal for the future. I think AI more generally has given them stuff today. Their ads business is largely more concentrated. It's more targeted because of the AI that they have. The feed is more personalized because of the AI that they have. But I think the metaverse and this idea of, putting on glasses or goggles and sort of going into a virtual world, that is still so new. There doesn't seem to be any real, immediate impact on the business there, other than it's losing them a lot of money today.
Yeah, absolutely. I think in the neighborhood of $4 billion, as the last results show. Kurt Wagner, thank you so much. Kurt Wagner covers the social media companies for us here at Bloomberg News. Let's get more analysis now on Meta and its advertising business and bring in Mark Douglas. He is the founder and CEO of Mountain. So, Mark, we know that Meta has this large language model called Llama. It's open source. Technically, theoretically, it's supposed to help its advertising business. How do you see this working? Or is it actually something that Meta doesn't really need?
Well, there are two things that Meta is doing with AI. So one is focused on continuing to drive performance for their advertisers, the 10 million companies that advertise on Meta, and that can benefit from AI. And the other thing is increasing engagement on Instagram and their other platforms, Facebook and the other platforms. For the advertising biz, I actually don't think there's a lot of room for them to get better. They are incredibly good at using data to drive revenue for their customers. And I don't think people quite realize how good they are. If you take branded search out of Google's business, Meta is roughly not far behind Google in size, advertising revenue, and they don't have keywords to use. So, I mean, they're driving all of that just off of data and doing an incredibly good job of it. So I think people should, investors should be wary that there's going to be some massive increase in advertising revenue because AI, because I think Meta's already at the top of the scale there.
Are you surprised, actually, that they haven't made more of a push into some type of a more developed search engine?
Not for Meta. I mean, people don't want to go to Meta for search. When you're in the mood to shop, you don't think, let me go to Instagram. And so what you do is you discover products on Instagram that Meta has figured out might be of interest to you using all sorts of other data other than search. So I don't see Meta ever really trying to challenge Google in search. I mean, in theory, with AI, maybe they try to make that move, but then they're also competing with OpenAI and Microsoft. I think where they're at right now, they have a really strong position.
I gotta be honest, I actually do go to Instagram to buy makeup. I'm just gonna put that out there because they have the cool stuff in Reels. I'm just saying. So if you're skeptical that their advertising is going to be able to get more out of AI because their advertising is already really good, how else then can they use AI to either increase ad spend, get more money out of each ad?
Right. So the real thing is, can they increase engagement to continue to stay ahead of TikTok and get you basically more hours in Instagram, and who knows what apps are available in the future. I think there's a lot more room for them to grow. The problem there is product market fit. Like, you can come out with a bunch of AI features, but people have to actually like them and use them. And it's product market fit, and that's not easy. That's not in the background driving ads. That's in the foreground getting people to respond. So I think they'll just keep iterating, and I think they will be successful there, but it's going to take a bit of time. And increasing engagement on Instagram will increase revenue.
I'm sure you've been watching the Olympics, Mark, and there have been a lot of commercials from Google advertising Gemini, its AI model, during, in between competitions. Are they doing a good job making a case for why consumers should be engaging with this function, or is it still kind of leaving people bewildered a little bit?
Well, I think obviously they've stumbled during the launch of Gemini. I mean, a massive stumble. Stumble's an understatement. But ultimately it is Google, and so much of Google's position is just that you have muscle memory to go to Google.
Yeah.
So but they have to back it up, right? Like, it actually has to work, and it has to be a benefit before maybe Microsoft or OpenAI, ChatGPT, and other platforms start to catch up. So I'm not surprised at how much they're advertising Gemini, but I don't think they have an advantage at this point. I think people just see AI as new, and they see as ChatGPT and maybe Microsoft with that partnership as kind of being leaders there, and people tend to want to go for the leaders.
And it'll be interesting, too, to see how much we see this mashup between AI and search. Mark, though, I do want to sort of pick your brain here, your advertising brain specifically, and push ahead, because we are going to get some earnings over the next couple of days from Apple and Amazon, two, I don't know if you call them major streamers, but certainly major companies that have really been trying to make inroads in that space here. When you look at those streaming services, The ad strategy that they've taken, both on the Amazon and Apple here, what improvements do you think they could make that would maybe make it more palatable to investors?
Yeah, well, I think Amazon's on a different level because Amazon is is way ahead of the rest of the streaming industry in not only having a brand advertising business, but bringing their performance advertisers over from the Amazon homepage. So the Amazon homepage is search advertising. You enter what you're looking to buy, and then it not only shows you products, it shows you sponsored ads for often the same products or other products. And they're bringing those advertisers over into television. It's pretty similar to what Mountain's doing in terms of performance advertising. I think that's just giving them incredible advantage. And you can see it play out in that they flipped their entire customer base over to ad-supported in one day, and no one else has been brave enough to do that. And that's because they were very confident in their ability to monetize it. So they're just way ahead in the ability to do it, monetize it, grow it, and things like that. I think Apple has always been cautious about advertising, and that cautiousness is going to have them lag behind.
How important do you think that ads are going to become to Amazon, considering that it really is still just an e-commerce company with the cloud, which I get?
Yeah, I mean, I think it's going to be a massive profit driver for them. People, I still don't think people think of Prime as the first place they want to go for streaming, which is why, the likely reason Amazon has been heavily investing in sports programming and other programming that starts to get that into your mind. But it's going to be it's a hugely profitable business from everything anyone can tell for search, going to Amazon and entering what you want to shop for and having search ads. And I expect the same with streaming. And the person running that, the team running that, they're incredibly sharp. They built both of those businesses from scratch and done a really, really good job doing it.
Mark Douglas, founder and CEO of Mountain, thank you so much, giving his thoughts on Meta as well as Amazon and Apple, which will be reporting in the coming days. As we've been talking about, a lot of earnings coming out today, and we're looking at the move in after-hours trading. You could see Qualcomm there holding on to a gain of 6.4%, and that, again, is after its sales beat suggests the return of smartphones. People clearly liking what they're hearing from this chip maker on a day when chip makers gained overall. But Carvana, the standout here, gaining 10% on the day, turning a surprise profit as a used vehicle sales company.
Yeah, looking at eBay, though, those quarterly sales and profit did exceed analyst estimates. However, the stock is still down in pre-market, in post-market, I should say.
All right, a lot moving here. MGM as well here. Interesting story on Aurora Innovation to keep an eye on that. And record profits over at Pilgrim's Pride. A lot of movers here in after-hours trading that could really shape the tone for the cash session in the morning. Stick with us. A lot more coverage coming up here on The Close. This is Bloomberg.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. We have made no decisions about future meetings, and that includes the September meeting. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
That was Federal Reserve Chair Jay Powell earlier after holding rates steady this meeting and signaling potential cuts in September. For more analysis is Betsy Duke, former Fed governor and former chairman, as well as Fargo, as well as Ken Shinoda, a portfolio manager over at Doubleline Capital. Betsy, let me start with you. The if was really key. What's the data going to be that if everything keeps going okay?
So exactly. It is if things were going in the same direction that they are right now, I think the Fed is pretty happy with that, and they would consider that would be longer than just 1 quarter of data in that direction and probably be ready to make the first move.
This gets us to a question, Ken, here. What are the implications for that? If we do end up getting that here, are we talking about a weaker dollar, obviously potentially a lower rates here, but what is kind of the moves that we see in between?
Yeah, I think you could see a little bit weaker dollar on that move, especially as some of the other currencies around the globe like the yen potentially appreciate. You saw this morning that the BOJ came off of zero after decades plus, long time down there. And the short-term rates are the most poised to fall as the Fed normalizes interest rate policy. So that front end of the curve we expect to come down meaningfully as they start normalizing policy.
Betsy, the statement sounded pretty hawkish. And then during the news conference, he was much more specific and said September a number of times. So what exactly are they waiting for? Is it waiting for the sake of waiting, or is there, a specific data point when it comes to unemployment or when it comes to inflation that they need in order to get that confidence?
So first of all, I'd be careful about counting the number of times he said September, because you also have to count the number of times they asked him about September, and he answered about September. So I think it's more that they need more data that looks the same, and a sense that the data is going to stay the same. And I would also caution that the first move doesn't necessarily mean that there is a race to normalize. It means the first move. But there's still a fair amount of uncertainty out there. In addition to normal uncertainty, you have the uncertainty of an election year, which is uncertainty for economists, for businesses, for consumers, for everybody. And then remember, in 2025, you have the certain expiration of the Trump tax cuts. So even no action is going to be a pretty strong effect on the economy.
Yeah, that's right. Several is what Powell said. And I don't really know what several winds up meaning. Hey, Ken, if I'm looking at the bond market, what's my several? Like, if I look at the 2-year, is several 3.5% on the 2-year? What is it?
Well, right now the bond market's pricing in about 2 to 3 cuts, probably 3 after today's move in rates lower. And the terminal rate expected by the market is kind of around 3.5. But I agree in the sense that they are very data dependent. They got finally some relief on shelter inflation on the last CPI print. Shelter inflation really lags kind of the broader market indicators that we look at in the real estate market. Rents have been coming down meaningfully. And finally, that moved in the last CPI print. And I think that gave them a little bit of hope. But what they really want to see, I think, is that they want to see the employment components of the job markets continue to weaken and slow down. They want to see that quits rate continue to come down. They want to see the job openings continue to come down. I think they want to wait to get a more meaningful signal that services inflation will remain low, and we won't see a reacceleration of that.
It's an interesting point that Ken brings up there, Betsy, particularly on its services inflation. Bill Dudley kind of made an interesting comment about how the Fed's own internal inflation metrics are probably a lot closer to 2%, to the point of it almost being a rounding error at this point. And the idea that if we start to see those other metrics, the more forward-facing ones, also move down there, it raises the question as to whether the Fed is already behind the curve. Do you buy into that argument?
I don't think behind the curve, and I think appropriately cautious. And it is services, but in addition to services in particular, it's housing. And I think housing is going to take a lot longer to come down and stabilize than anything else, because you just have such a shortage of housing and have had for decades.
You know, we've got a lot of jobs numbers coming up in the next 2 days. You've got, the ADP stuff, we're in the challenger job cuts, and of course, then you have the actual jobs report, Alex, that at this point, is it as market moving as it would have been 2 days ago?
Well, I don't know. I feel like Jay Powell made that very market moving, Betsy. I mean, I feel like he put a lot of emphasis on that jobs number in a big, big way. What are you going to be looking at? What do you think we're going to get?
Well, first of all, jobs numbers are frequently revised as many as 100,000. So to move markets on a single number, it seems insane to me, but that's the way markets go. Also, markets tend to quite rationally try to determine where they think the end point of Fed's moves are going to be. So today, now there's an expectation for 3 cuts. I read the Fed as much more cautious than dashing out with 3 cuts before the end of the year.
Oh, interesting. So it gets to a question here, Ken, and when we start to talk about whether the data is going to be supportive of those cuts, that Jay Powell alluded to, cuts that the market is pricing in here, how much is that going to change longer-term positioning in the fixed income space? And I guess basically what I'm talking about is for someone like you who's kind of a short-term duration guy by, I guess, job title, do you think you'll see more of your peers extend duration?
I think a lot of people have already extended duration into the backup that we saw into the fall of last year, maybe here when we got back up to 470. So I think most bond managers have extended durations to close to the longest that they've probably been in over a decade, just given where, how high absolute yields are. We've seen a pretty good run. I think the market is pricing in, a lot of this softness and or easing into the marketplace. And usually you'll probably see a little bit of reversal. We saw that at the last Fed meeting. We had a good CPI print. The market kind of rallied into that and then kind of backed off a little bit, about 20, 25 basis points. I think we've run a little bit too far, too fast here. I wouldn't be surprised to see a little bit of a pullback. Could be a good buying opportunity for investors looking to add that duration into their portfolios.
I'm looking at the 2s10 spread, Ken, and the yield curve steepening just a bit today after that 2 p.m. announcement and, of course, during Powell's comments. What does the shape of the yield curve look like to you until September?
Well, I think we'll stay kind of the slight inversion. Maybe we can flatten out. I don't think we're going to see too much more steepening into September. I think the market really wants to see that cut actually happen as opposed to just the threat and the talk of it.
Yeah, no, fair enough. All right, Betsy, before we let you guys go, a final word. How did you think Powell did today? Do you think he got the right message across in the right way?
Yeah, I actually think this was one of his better press conferences. I think he was cautious not to lead markets too far down the path to lower rates, but he acknowledged that was the discussion that was teed up for September.
All right, Betsy, always great to talk to you, as well as Ken as well. Betsy Duke, former Fed governor, Ken Shinoda, portfolio manager over at Doubleline here on this Fed day. I guess relatively decent endorsement out of Betsy as far as Jay Powell's performance. I don't know how he stands there and asks those questions. And I love how she responded to your first question, right? You can't count the number of times he said September unless you count the number of times he was asked about September, which I guess is a good point.
Reporters were definitely pushing him in a certain direction to just, come on, give us something concrete here.
But it was interesting just to see that in general, like economists kind of split. Like, was he just dragging his foot then for a cut since they already talked about it? Or are they actually like baby stepping towards it?
Yeah, well, it sounds like it is, or at least that's the hope in the markets right now. We're going to set you up for some of the potential market moving events going on over the next 24 hours. That's when we come back after the break. This is The Close on Bloomberg. As we wrap up a busy day, a push ahead to some of the potential market moving events over the next 24 hours, and we start tomorrow morning with more earnings, Scarlett.
Yeah, you've got Wendy's, you've got Shake Shack, Crocs. It's a real read on the consumer. Certainly there's ConocoPhillips and Moderna, which is a different part of the economy, but I'm really curious to hear what these companies have to say about consumers seeking deals.
Yeah, and I think aftermarket, though, we get some big ones as well.
Ooh, yeah. Apple, Amazon, Intel, Roku, Coinbase. Apple, though, that AI smartphone super cycle. Will we actually get indications of that?
I'm in the upgrade cycle now. Like, I kind of feel like I have to buy a phone just because my other one's kind of crappy, but I don't want the AI stuff.
Well, then can you turn it on and off? I don't know the answer to that. Like, what if you didn't want it?
Yeah, that'd be a good question here.
Is that an option?
We don't know.
All right, we get another rate decision tomorrow as well, this time from the United Kingdom.
Yeah, the Bank of England, of course, is meeting, and of course, they'll have the press conference right after. It'll be curious to see whether they stand pat. 5.25% is their current rate.
And we also get some economic data back here in the U.S., including jobless claims as well as some of those manufacturing numbers.
I love the ISM at 10 o'clock, especially the employment read into Jobs Friday.
We will have full coverage of that right here on Bloomberg Television. Join us tomorrow right here on The Close.